All right, welcome back on our series with NonProfits, really focusing on what we call the generosity crisis. This topic today is going to be about audits and compliance and financial reporting. Probably a very exciting topic for a lot of you, but it's very important. And that's what we do, so that's why we enjoy talking about it. But let's just jump right in. So we know in California at least, and every state has its own requirement, but in California, every nonprofit with more than $2 million in revenue or funding of some source needs to have a financial statement audit. And the complexities involved with that, along with compliance with other grants or other donor restrictions, can become fairly complex. And we also know that accounting talent and the financial market can be challenging to find and can also be pretty expensive as well. So what are organizations doing?
Yeah, so if you think about it, to get to $2 million, that's not much funding, and that's a pretty heavy requirement. The audit requirement requires a level of expertise that sometimes organizations of that size don't have. So I've just seen organizations really struggle in that manner. They might have manual, like paper records, and then a manual process, and not quite even understand what's being asked of them in the audit process, but yet it's this requirement that comes down from the state that they have to comply with. So I think organizations of that size have trouble attaining and getting that level of expertise and talent on their staff. And so it is an area I see of concern that organizations have as they try to meet those sort of regulatory obligations.
Yeah, and I think one thing that we've talked about too is when you look at the investment that organizations have made or are making in the organization, in the infrastructure associated with the organization. Now, we do know that as these organizations gained a lot of funding and received a lot of funding during the COVID crisis, there was some infrastructure that was built and incurred. Some of those challenges are happening right now, but we also see in some cases where the investment in just administrative side of the business is severely lacking, right? I mean, maybe you can talk about that, Laura, as far as what we see as far as an industry standard versus some observations we've seen.
Yeah, so in your 990, in your tax return, you're required to show the percentage of really all the expenses that you have in programs and admin and fundraising separated out in the statement of functional expenses. And the sort of an industry standard would be to have 80% or so of your total programmatic, as a percentage of your total expenses on programs. And there's just when you think about what you think the donor might want to see, and sort of some of the metrics from some of these agencies, it really makes you want to invest in that manner, and that everything that you do is sort of poured back into programs. But when you do that and you forget about the infrastructure behind the scenes that you need in order to pay your bills and make sure you have the right level of funding and do some of this more proactive cash flow managing and forecasting and budgeting and do that well, it requires a certain size of infrastructure that many times I see that infrastructure lacking. And I always say that if you have that I think of accounting and finance as this foundation, right? And if you have a cracked foundation, your programs teams ultimately can't thrive. And like we said, it's all about this long-term sustainability so that you can achieve a greater missional impact and ultimately help more people in the community.
Great.